Financial Simplicity, Part 24, Diversification and Rebalancing. If managing risk is the name of the game, diversification is your first line of defense. Rather than betting everything on one investment or one market, diversification spreads your money across different types of assets so that no single loss derails your plan. Think of it like this: if you put all your savings into a single stock and that company fails, you're in trouble. But if you invest across dozens or even hundreds of companies, you're much less exposed to any one of them falling short. The same applies across sectors, countries, and even asset classes like stocks, bonds, and real estate. Some may rise while others fall, but together they smooth out the ride. Diversification isn't just about protecting downside, it's about emotional resilience. A well-diversified portfolio gives you the confidence to stay invested, even during market turbulence. That consistency is what leads to real long-term growth. But portfolios don't stay balanced on their own. Over time, your investments will perform differently, and your mix can drift. For example, let's say you started with a 50-50 split between stocks and bonds. After a few strong years for the stock market, you might now be sitting at 70-30, more aggressive than you intended. That's where rebalancing comes in. Rebalancing means periodically adjusting your portfolio back to your target allocation. That might mean selling some of the assets that have grown too large and buying more of what's lagging. While it may feel counterintuitive to sell what's been doing well, this strategy helps you lock in gains, control risk, and stick to your plan. Different behavioral profiles will approach diversification and rebalancing differently. Conservative investors might hold more bonds and rebalance more often. Aggressive investors might lean into stocks and tolerate more drift before adjusting. The point is not to chase perfect timing, but to stay aligned with your strategy. A financial advisor will build a diversified portfolio that matches your goals and timeline and keep it properly rebalanced as the markets shift. They'll make sure your strategy doesn't quietly drift into riskier territory than you're comfortable with. In the next article, we'll look at two of the most powerful tools available to Canadians: RRSPs and TFSAs, and how to use them right. Ready to take the next step? Visit our website to start the conversation at greenhelixfinancial.com.